Hi, everyone. Welcome to Commercial Real Estate Bosses, where we interview badass investors who are crushing it in the commercial real estate space. I'm your host, Ciaara Hoffman, and on today's call, we have Bethany LaFlam with Premier Law Group. So, Bethany, I'm really excited to have you on the show today.
Thank you so much for having me. I'm excited to be here.
Awesome. Well, you're the very first lawyer we've had on the show, so I'm really looking forward to diving deep into some topics that we've never covered before, never been able to cover because we haven't had, someone who's practicing law on here. Now, before we get into the nitty-gritty of things, I just want to understand more about your story, your background, and how did you get into doing law for real estate syndications and funds?
I actually did not start off in the real estate space. When I was growing up, I grew up in Ohio, and we grew up pretty poor. And I thought that my only way of getting out of that life was to become a doctor or a lawyer. So I didn't even know that entrepreneurship was on the menu at all. So I was pre-med at first in college, and I hated it. So lawyer it was. So I went to law school, and I moved to California from Ohio for law school and sort of never looked back. Right. So
nice.
I went into law school. At first I thought I wanted to be a trial lawyer, a litigator, and realized that I did not love that. So I started off actually, or then moved into mergers and acquisitions, and I worked in venture and did a lot of work in startup capital raising. So I was still in securities, but not in real estate. I hadn't discovered yet real estate. So when I took a little break to raise a fund, and then I met Mauricio, Raul, my partner at Premier Law Group. And I really just came in to help him for a little while, and he was coming off of being ill and needed someone to help him. And I just was like, I'll help you out, but this isn't where I'm going to land. I don't really want to do this. And then I started meeting his clients, and I'm like, well, these clients are awesome. This isn't like working with venture capital, and this isn't working in M&A where people kind of treated me like I was the help. I was like getting to partner with people and really help people achieve their dreams and build their empires and leave their W-2 jobs. And it was just much more satisfying. So I just kept doing more and more and more, and now I'm running the entire firm. So,
oh wow,
so here I am. Because I was doing these documents, and I'm like, wait, what do you mean they get returns right now? Like in venture, you have to wait for years before you get anything, if you get anything at all. So it was so much, new that I was like, oh my gosh, I can't believe I've been missing out this whole time. So I love it.
That's awesome.
Great.
I love that. I kind of have a similar-ish background as I did my pre-med as well. And I didn't know what an entrepreneur was. And I feel like it's good now that it's just so much more known and popular to know like what an entrepreneur is. So I love that story. Now, I wanted to cover what the top 3 mistakes that new syndicators make when it comes to law, because I know that, a lot of our listeners are new into the industry, and there's just so many, legal things to kind of watch out for when getting started, especially when it comes to knowing the differences between a 506B and 506C, how to navigate that. So I thought we could just dive right in and go with the top 3 mistakes that new syndicators make when they're getting started.
Absolutely. Absolutely. I think the number one conversation I have with both new and experienced syndicators, actually, because I keep having it over and over and over, because it's typically an answer people don't love, which is, how do I pay capital raisers, or how do I get paid to raise capital? And so the biggest mistake that people make is not understanding the rules or not following the rules around when you can get paid when you're part of a deal. And that sort of bleeds over into one of the other mistakes people make. But the biggest mistake is trying to pay capital raisers just to raise capital, transactions-based compensation based on how much they raise or whether or not they raise. And that is a no-no. In order to get compensated based on a capital raise, you have to have a license, a broker-dealer license with FINRA. Right?
I see.
And a lot of people in this space, they don't have it. And I know they don't have it when they ask me these questions of how can I pay a capital raise? Because if they had the license, then they would know. So, people have to be really careful. I see a lot of people posting on Facebook or Instagram, hey, we're looking for capital raisers for our deal. We'll give you 5%. We're just $1 million short. Right. That is a big no-no. That's definitely not allowed. And
Wow.
I know that there are a lot of lawyers that sort of let it slide or kind of turn a blind eye. And we're really conservative at Premier Law Group because the SEC exists to protect investors from you, from people raising capital. We exist to protect capital raisers or operators, right? When it comes to raising capital. And so my job is to protect the issuer, the sponsor, right? The syndicator. And so what I will tell you is if you want to get paid to be a part of a deal, then you've got to be a partner in the deal. You've got to be a co-sponsor in the deal. And that could include raising capital. Absolutely. Of course you have to raise capital, right? But it can't just be raising capital. And so the biggest mistake is people come in and they'll take 5%, 10%, whatever it is of a deal to raise $1 million. And, or sponsors will start calling out people to go and raise capital for them because they're short or whatever it is, right? And not only is that a violation, it's also dangerous. It's dangerous because when you bring somebody into your deal, they're becoming a partner with you in the deal. Okay. And if you haven't done enough vetting because now you're desperate to close, right? You're desperate to raise the rest of that money. There's not always a proper vetting, which is the second big mistake. So we'll get to that one in a second. But if you are going to be part of a sponsored deal, you have to have substantial duties in that deal. That could be part of acquisition. That could be diligence. It could be asset management. It could be partially investor relations, dealing with the lawyers, putting together the business plan. Those are all jobs. But the thing to remember is that whatever you get paid for raising, in the deal has to be based on those substantial duties, not on how much or whether or not you raise. So if you come into a deal and you're doing 30% of the work, then you should be getting 30% of the GP, right? Of the sponsor, whatever the sponsor is getting. If you're coming in and you're doing like 3% of the work, but you're raising all the money and then you get 10% of the deal, it just has to match. It has to make sense. So what you have to do is really get comfortable that if an SEC investigator starts coming and looking under the hood, right, and trying to figure out if you've done anything wrong, are you comfortable with your facts? Right? Most of the things that the SEC does in their investigations is they're deciding things based on a facts and circumstances analysis. So you need to have more good facts than bad facts to convince an investigator. And that is a hard way to manage your business because you don't know what kind of mood that person's going to be in. I mean, there are rules and you could have violated those rules. But if it's like, well, we've got all these really good facts, like we didn't mean to violate that one. And, if you have better facts, you could be okay. But what we try to do is keep you out of the crosshairs from being investigated at all. And so to do that, we need to make sure that everybody is a real partner. And, we see sponsor teams that are getting a lot larger nowadays when it's harder to take down a deal, or you've got new sponsors doing deals that need to have other co-sponsors to help out. Totally understand. But if you start getting 8, 9, 10 sponsors on a deal, it's going to look like there's some capital raisers in there. And it's hard to dole out the work, the substantive work besides capital raising among that many people. It's not impossible, but it's tricky. And so one of the things that we do at Premier Law Group is we'll help structure it and guide you and make sure that you keep your facts good. If you don't like your situation, you don't like your circumstances, you just change your facts, right? And so we can't change the rules, and we definitely don't help people get around the rules. We just help them make their facts match what they're allowed to do and what they need to get done. So it's a tough balance sometimes. So that's the number one rule is paying capital raisers just for raising capital or trying to get paid just for raising capital. So you got to make sure you bring something else to the deal if you're a capital raiser too. So I don't even like when people call themselves capital raisers. If you've seen me talk ever anywhere, you hear me say, just don't call yourself a capital raiser. You're a co-sponsor, you're a syndicator, you're a partner. And so that leads into the next big mistake that people make, and that is to not vet their partners well enough. So you've got people that are like, look, I'm just trying to get a deal done, and here's what I do, and I need someone else to do all this. Just come in. Can you do it? Can you do it? Or even worse, bringing them at the end of the deal to try to finish the raise, right? Everybody who's going into a deal has to remember a couple of things. One is you guys are partners now. You're partners for 5 to 7 years on average, right? That's how long the life of these deals are. So you're partners. So you got to make sure you all like each other, and you got to make sure that you've lined out what everybody's responsibilities are ahead of time, what everybody's getting paid ahead of time, so that you don't run into issues if there's ever a problem in the market, there's a problem with the property. And the bigger the sponsor team, the more likely that is to happen because you've just got more cooks in the kitchen, right? So there is also a responsibility of all of the sponsors to do diligence on their co-sponsors, right? You have to check and make sure that you're not partnering with any bad actors, anybody who's been barred from raising capital. You should also check on people, for example, who are out calling themselves capital raisers. And even if you as a sponsor are doing all the right things, saying, you know what, I have to give you a substantial job. I can't just pay you to raise capital. I'm sorry, I wish I could. If that person's still getting paid for raising capital for other people's deals, that could make you a target. So you've got to do diligence and see what kind of person am I getting into business with here? Are they getting paid to raise capital for a bunch of other people? If they get investigated, guess what's going to happen? Every deal they've raised for, every deal they've been a part of is likely to get investigated. And so even if you're trying to do all the right things, you could get into trouble if you partner with the wrong people. So that is really the second one. And I'll pause for a second because this one usually raises a lot of questions. So I'll pause for a second in case you have some questions for me.
Yeah, I would say, you mentioned being able to vet people's backgrounds. How do people go about that? What's the good, like, other than just, stalking them on social media? How would we vet these people?
Right? I mean, so much is out there, right? I mean, people just can't help themselves, especially capital raisers, because they're out promoting whatever deal they're working on, right? And so, which is going to get me to the number 3 issue. So they're all kind of related. But yeah, good old Dr. Google and stalk them on social media for real. I mean, you could go as far as getting a background check, and I definitely recommend that if you're going to be really partnering with people, get a background check on everybody, and you offer it too. I mean, and if anybody tells you that they don't want to do that, it's kind of a red flag, right? Now, do you need to go so far as to like dig into their credit history? I don't know. It depends. Are you going to have them sign on the loan? It depends on the circumstances, but for sure, anybody who's going to partner with you, if they're upset about you trying to dig a little bit deeper, that right there is a red flag. And securities issues they're serious. So you want to make sure that you're not inviting trouble, because if they raise $1 million for you, that's awesome until you have to give it back because they turn out to be a bad actor. So yeah, I mean, we're all pretty good at these days about stalking people on social media. There's so much out there publicly now that it's kind of easy now to find.
Exactly.
And Google, it's hard to get rid of anything on the internet. This is what I always tell my 15-year-old daughter. Right? Can't delete anything.
Very true.
Yeah. So the third biggest mistake is, and it kind of goes along the lines of not knowing who your partners are, but you have to understand your investment, your strategy up front, because if you get excited, and a lot of students do this, right? When they first come out and they're learning how to do a deal and they're so excited and they get under contract and they're just blasting it all over social media. Like, oh my God, you guys, everybody look, we're under contract. And then they come to me and they're like, okay, we're going to do a 506B, which means that they want to be able to accept non-accredited investors. Well, guess what? If you are able to accept any non-accredited investors, and I know you wanted to know what the difference between 506B and C is, actually, I'll pause for a moment and say that. A 506B is an offering where you can accept into your deal up to 35 non-accredited investors and unlimited accredited investors. An accredited investor is anyone who has a net worth of $1 million or more, not including their primary residence, or has had income of $200,000 or more for the past 2 years and is reasonably expected to have that again this year. And it's $300,000 if they're going to include their spouse. So 506B, you get to take up to 35 non-accredited and unlimited accredited. However, in a 506B, you cannot generally solicit and you cannot advertise. You have to have a pre-existing substantial relationship with all of your investors, or some other way to prove that you didn't generally solicit or advertise. So blasting it all over social media is a big no-no when you want to be able to accept non-accredited investors. 506C, you can blast it all over social media. You could take out a billboard. You can do a TV commercial if you want to, as long as it's true and not misleading. But then every single investor has to be accredited, and you have to take reasonable steps to actually verify that they're accredited before you take their money. So those are the two big differences there. So if you decide, hey, you know what, this is my first deal and I really want to let some of my family members in. Well, I don't know about you, but my family members are not all accredited investors. So if I was going to do a deal and I wanted to allow some people that I have close, substantial relationships with, it would have to be a 506B deal. But that wouldn't be available to me if I got all excited and I blasted all over social media that I'm under contract, because that could be construed as what's called conditioning the market. So even if you're not on social media asking for money, even if you don't give the address of the property or show pictures of the property, if you go out there and start talking about a deal when you have 506B, a 506B offering, then it could be conditioning the market, which is also not allowed. Right. So the SEC regulates both the offer and the sale of securities. So if you're out trying to drum up excitement about your deal, that looks like an offer. So that's a big one. And this kind of goes back again to when you don't know all of your sponsors. I've actually had it happen where there was a sponsor team, about 6 or 8 people. They call me. Not everybody was on the call right away. They say, well, we're going to do a 506B. Okay, great. Have you advertised? No, we have not advertised. Okay, great. You hear all the rules. Then they call me and say, okay, well, one of our partners actually put it on social media, like the 6 out of the 8, right? Put it on social media that we're under contract. That blows the exemption for the whole deal. So that one post, just because they weren't clear with all their partners about what their investment strategy was going to be, probably because they weren't really acting like true partners, then that blew the exemption, and then they were limited to accredited investors only. So that was a big disappointment for their team. So now I try to remind people up front, like, hey, just make sure, as you guys are looking at properties, I know it's not really time necessarily to engage your securities lawyer, but be mindful, because you could blow it before you even ever get started in the raise. So, the social media is kind of a big one, and people are always asking me, what can I post? What can I not post? And the answer is, if it's a 506B deal, you really are limited to education, any value add. You can talk about your team. You can even talk about like what markets you like. We like multifamily. We like 500 or whatever. Not 500 units is kind of whatever, however many units you like. You can talk about like Class C buildings or whatever it is. But I would advise you to start doing that consistently before you have a deal, so it doesn't look like you're conditioning the market, like you're quiet. Suddenly you have a 506B offering, and all of a sudden, well, we're not talking about deals, but we are talking about how great we are. So you have to just think about, like, what is the reason I'm posting this, right? If it's to drum up investor interest, then you can't do it in a 506B. In a 506C, you can say almost anything, as long as, again, it's not misleading, and as long as it's true. And so you've got a lot more leeway of what you can say in a 506C deal. Now, I still like to check out my clients' posts and their websites, even when they have 506C offerings, just to make sure. So, for example, you can't promise a certain return, right? You can't say, hey, we're going to 10x your money. You can't say, we are going to get you a 30% return. That sounds a little promising for the SEC's taste. So we do like to give disclaimers and or at least kind of soften the language. And then, another point on social media really is you should be treating your social media like a top of funnel. You're not going to close deals based on an Instagram or a Facebook post or a YouTube video. No one's going to invest $100,000 or more based on one post that you do. So there's no reason really to risk it.
Right. Yeah.
Right? You're filling your funnel. So I know I just kind of put a lot on.
No, that's good. That's really, like, I've actually learned a lot already in the 20 minutes that we've been together. I have a couple questions in regards to the last topic we just covered.
Yep.
The first question I have is, so you mentioned, you need to have a substantial relationship with your investor on a 506B. So how can you prove that you have that, other than them being like a relative? Like, at what point can we say, I have a substantial relationship with this person?
That is a really great question. And the best way, we actually offer an 8 steps to turning a podcast listener, for example, into a 506B eligible investor. And I can send that to you if you want to send out to any of your listeners and viewers. We give it out just for free because I want everyone to know. But the SEC has given us some clear guidance here. And the best way to prove it is a couple of things. The first one is you want to make sure when you meet someone that you take it a step beyond meeting them. You want to have them even fill out a questionnaire, for example. So if someone reaches out to you from listening to this podcast and like, hey, I want to invest with you, Ciaara. Then you say, great, love to set a call with you. In the meantime, please fill out this questionnaire. The questionnaire, which is included in those 8 steps that I'll give you, the questionnaire is going to include things like, what are your investment goals? Some of it's pretty personal, like how much do you make? That's actually relevant when you're talking about how much people are thinking about investing. You're going to get an idea of their level of sophistication, right? You're going to get to know them. Follow that up with a phone call, really get to know them. So it's really substance over form here. So you can't just say, well, I met them 3 months ago, 3 months has gone by, now it's good, right? You've got to actually develop a substantial relationship with that person, get to know them. If you can't meet them for coffee because of location, at least have a Zoom where you can see them face to face and maybe go over that questionnaire. So those are some guidelines to developing that relationship. The other thing is to keep immaculate records. Be organized. I definitely recommend that you have an investor portal where everything is housed. Don't just email your offering documents and then then everything's an email. And then if you get investigated, you're trying to dig through Gmail for 5 years ago. Keep everything really organized on an investor portal. I highly recommend that. And that's going to help you. It's just peace of mind too, but also investors start asking for stuff. You can easily go and get it and send it to them without having to search through and dig and find things. And so I think organization and just really developing that substantial relationship is going to be the best way, so that if the SEC comes and says, well, we think that maybe you advertise, or we think maybe you don't know all these people, or you generally solicited, you can say, no, I met them here. And and I know these things. And part of the reason is if the deal goes south, if there are problems, and the SEC starts asking your investors, well, like, how did you know Ciaara? They are not your best witness when they've just lost $100,000, right? They're like, I don't know. I heard a podcast one time. He started asking me for money and then I lost it, right? They're not going to help you at all. So you got to be able to show that you really did know them. Now I will say this, the rule is that you cannot generally solicit or advertise. The best way to prove that you didn't is what I just said, which is to have that substantial pre-existing relationship. It is not the only way. So for example, if you and I have a substantial pre-existing relationship and you're telling me about a deal that you have and I'm like, oh my gosh, this deal is awesome. But, my sister, she invests in everything that I invest in. Can I show her this deal? You can accept my sister into your 506B deal, even if you don't know her. Mm-hmm. But you cannot allow me to go do anything on your behalf that you're not allowed to do. So I can't go blast it on my social media. I can't go generally solicit for you.
Got it.
And you cannot pay me for the referral.
Got it.
You can accept the referral as long as I'm not advertising or soliciting for you, but I just have to do it because I love my sister and I love your deal, right? And that's it. Awesome. I can't get any money for it.
Okay, that's good to know, because literally I was talking to, a potential LP recently, and he's like, well, I think my dad would like to invest. And I wasn't sure how that all worked. So you just answered that question.
I always make sure to tell people now, because I remember when I first said this to people, gosh, I think it might have been at Peak Partnership, Multifamily Mindset Peak Partnership last year. I said it from stage, and people came up to me like, we have left hundreds of thousands of dollars on the table because we didn't know we could take referrals. I'm so sorry you didn't know that. So now I feel like it's my obligation to tell people, like, no, you can take referrals. Please take the money.
Yeah. Awesome. Yeah. All right. And then the other question I had, so you mentioned, you can't promise a certain return. But I see posts all the time, everyone's saying, 18% ARR or IRR. So do you just have to always have a disclaimer? How does that work? Or are people just always breaking the rules?
Well, it's a little bit of both. I mean, people are breaking the rules a lot. I see posts that make me cringe daily. And so what you need to do, if you're going to talk about that, you could talk about a targeted annualized return. if there's a property and there's something to back it up. So if you've done the underwriting on a property and you think I'm projecting that this is going to be a 12% IRR or whatever it is, I'm projecting that, then you can say projected or targeted. Okay. But always have that word that it's not guaranteed, whatever. The other thing you can do is if you're offering a preferred return, let's say there's no split and you're just offering an 8% preferred return. You can say we're offering an 8% preferred return, because a preferred return is still not guaranteed. Okay. All the preferred return is it says, if the cash is available, you're going to get all of it until you've hit 8%, right? It's not a guarantee. Yeah. So it's just commonly known that that's what preferred return is. So, but that, again, I work with my clients to help them learn this. And part of it is, let me just review your stuff. And then the clients start to learn. I also have an education program that we put a lot of our clients through as well. So you can start to learn, and we teach the marketing people and the social media people and the investor relations / capital raisers, to make sure that everybody's on the same page. But, with our package, we'll review a one-time review of your social media and your website, so that okay, when I'm posting, I know that this is safe, right? But the biggest thing to remember in a 506B or 506C rather is just make sure that it doesn't sound like a guarantee, and make sure it's not misleading at all, right? So if you say our returns are 70% or whatever, because at one time you hit 70 and then the rest of the time it's like 15, that's misleading, right? Yeah. So you can't do that.
Got it. Okay, great. Well, any final thoughts or the biggest piece of advice that you give someone who is new getting into multifamily syndications today?
Yeah, there are so many free resources. I mean, there are amazing education platforms. If you're not already part of some sort of education or coaching program to learn, please do it. It's such a good way to learn the basics from other people who've done it without having to make all the same mistakes again. It's a really good way to network. It's a really good way to find good quality partners. But just keep learning, right? All along. Don't just wait until you find a deal and then try to figure out everything all right then when you're trying to chase a closing, right? You're not going to learn it all in 45 days when you found a deal. So just keep educating. But also, my biggest thing is you can build your empire, and I always tell people, build your empire using OPE. Everybody's heard of OPM, which is other people's money, other people's everything. Figure out what you are amazing at. Figure out what are your unique gifts and talents, and then stay in your lane. It's dangerous to cross lanes. If you're not great at it and you're dealing with other people's money, you really need other experts in there. So if you're not, and you can be learning at the same time, but make sure there's somebody there doing it. You don't want to learn on the job necessarily when you're dealing with other people's money. So other people's everything, leverage other people's everything, and then stay in your lane. That's really the biggest piece of advice I have.
Awesome. Well, thank you so much for your time, Bethany. What's the best place for people to find you online if they want to learn more about you?
My YouTube channel is Bethany LaFlam, and the law firm website is premierlawgroup.net.
Perfect. All right. Thanks again so much. And thanks everyone for tuning in. If you enjoyed today's show, please write us a 5-star review on Apple Podcasts or Spotify. Every review helps us to be able to reach more and more people that are looking to get involved in commercial real estate.